Welcome back to our series of talks. Last week we started to consider sections 187A and 187B of the Capital Allowances Act, and we're going to stay with those sections today. First, let's revisit the pooling requirement. In broad terms, this means that the vendor must add the qualifying expenditure to his capital allowances computations before the sale. Now, I say before the sale, but the actual requirement is that it must be done in a chargeable period beginning before the date of sale. So if the vendor draws accounts up to the 31st of December each year, and if the property sale takes place in January, but the trade continues, then the expenditure may be added to the computations for the year just started. In practice, this can take a bit of the pressure off at the time of the property sale. The practical problem, though, is that the purchaser will want to ensure that there is a binding commitment on the vendor to make the best possible claim. As a last resort, the buyer can go to tribunal to determine a transfer value for the fixtures if the vendor refuses to sign a fixtures election. But the buyer cannot force the vendor to pool the expenditure in the first place, unless, of course, he refuses to go ahead with the purchase. Suppose, though, that the buyer is not a taxpayer, but is, for example, a pension fund. Should the pooling and fixed value requirements still be met? Almost certainly yes, for two good reasons. There's no tax advantage for the buyer, but the election will help maintain the value of the property and will also protect the seller. Let's look at each of these in turn. First, then, the buyer's perspective. Even though the buyer cannot save tax as it's a non-taxpayer, it can still preserve the potential tax savings for a future owner by signing an election when it buys the property. When the pension fund comes to sell, this potentially increases the value of the property by perhaps 5 to 10%, depending on lots of factors. Signing an election is not difficult or expensive and should nearly always be done, even when the buyer cannot claim allowances. But what about the vendor? He or she may not want to pool new assets, but will nearly always want to sign a fixtures election, as failure to do so can be extremely expensive. This is best explained with an example. Suppose that the vendor runs a hotel that was opened at the end of 2008. Say that it cost £5 million to build, and that fixtures, including integral features, have been identified costing £2 million. And let's say that through a mixture of annual investment allowances and writing down allowances, the vendor has had tax relief on £1.2 million. There is therefore still a value of £800,000 to be claimed. The vendor and the pension fund purchaser could agree any figure for a fixtures election from £0 to £2 million. As the pension fund has no immediate use for the allowances, suppose that the parties agree a figure of £500,000. This gives the vendor immediate additional tax relief of £300,000. But if we continue with this example, what happens if the parties do not sign an election? Leaving aside a possible but rare complication, the £800,000 value is then lost forever. But the result is actually much worse than that, as the vendor will also then be forced to bring a disposal value into account. This is made quite clear at section 187B, subsection 6. So instead of getting tax relief on an additional £300,000, the vendor would in this case be hit by a balancing charge, which could well be the entire amount of tax relief that's been given on the fixtures in question. That is, in this example, £1.2 million. This is a hugely expensive and completely unnecessary outcome. For different reasons, then, both parties will almost always want to sign a fixtures election whenever a property is sold.